All right, let's pull back the curtain on a massive $200 billion shift happening right under our noses in the Indian market. Now, while everyone's eyes are glued to the Nifty's daily swings, the real smart money is quietly making a huge bet. And it's not on the next hot tech stock, but on the very power grid that's needed to fuel the entire AI revolution. So let's get into it and break down this hidden rotation.
Look, you have to forget the daily market chatter. Seriously, what we're tracking here is a seismic shift, a deep undercurrent happening in the shadows of the market. And this isn't about chasing some short-term gains. Oh no, this is a strategic move to control the physical assets, the actual power infrastructure that's going to underpin the whole AI economy.
And this slide right here, this perfectly captures the two different realities playing out. On the left, you've got the noise, the panic on Dalal Street, as people react to every single headline. But on the right, that's where the real story is. Those are the dark pool prints. That's where the whales, the big institutional investors, are operating in private exchanges, and they are systematically buying up every share they can get their hands on in India's core utility and power sectors.
And the sheer scale of this is just massive. We are tracking an estimated $200 billion. Let that sink in. $200 billion flowing into what we're calling the physical AI layer. And this isn't software or some app. This is the hard stuff. The solar farms, the battery storage systems, the high voltage grids that are absolutely essential if India is going to hit its 372 gigawatt solar target and power the data centers of tomorrow.
You know, the numbers just don't lie. Foreign institutional investors, FIIs, have yanked almost 75,000 crore out of IT services. That's nearly half their total outflows. Why? Well, because they see AI as a major threat to the old outsourcing model. So where did that money go? A huge chunk of it, nearly $500 million, flowed straight into power stocks in just one recent month. That is the biggest institutional bet on this sector in almost 2 years.
So what's the big idea here? What's the logic? Well, this isn't just a simple bet on growth. As this quote points out, it's actually a really sophisticated portfolio hedge. You see, instead of trying to bet on which AI model is going to win, these institutions are betting on the one thing that all of them will need: massive, reliable, and I mean massive amounts of power. It's the classic picks and shovels play for the AI gold rush.
Okay, so we know what's happening, but how is this rotation actually playing out on the charts? Let's dive into the technicals, because you can see the exact signals that these institutions are using to build their positions, right now, completely under the radar. For this analysis, we're going to zero in on two key proxies: Adani Energy Solutions and Power Grid Corp. These companies are right at the heart of India's grid infrastructure, and if you know what to look for, their charts show the clear fingerprints of institutional buying. Now this is where it gets really interesting. Take a look at the divergence. For Adani Energy, the MACD indicator is technically bearish. That would scare off most retail traders, right? But look closer. The RSI, the Relative Strength Index, is telling us that the selling pressure is completely drying up. And most importantly, the price is holding firm right above its 200-day moving average. That, my friends, is the textbook signature of a stage 1 accumulation phase.
And here's the sneaky part: the mechanics of how they're pulling this off. They aren't chasing the price higher and higher. No way. Instead, they are patiently, quietly absorbing every share they can at or near the volume-weighted average price, the VWAP, all day long. This lets them just soak up all the shares from sellers without causing a big price spike that would tell the whole market what they're up to. It is methodical, it is disciplined, and it is happening right now.
But we have to be crystal clear about something. This entire thesis, this whole $200 billion bet, it rests on one single critical variable: the cost of money. Building out India's grid is a 15 trillion rupee project. Now, if the US Fed keeps interest rates high to fight inflation, it makes it way more expensive for Indian companies to borrow money. That could completely crush the profitability of these projects. So this tug of war between the RBI and the Fed, that is the #1 macro risk to this entire trade, period.
And that macro risk is exactly what sets up the different paths from here. Now that we've got the setup, we can model the 3 most likely outcomes. And remember, this isn't about prediction. This is about preparation. It's about being ready for whatever the market throws at us.
Okay, so the bull case, the best case scenario. Here, we see a synchronized rate cut from global central banks later this year. This just floods the system with cheap capital. Then you add in the rocket fuel from India's carbon credit trading scheme and other production incentives, and boom, you kickstart a full-blown infrastructure supercycle.
The bear case, of course, is the mirror opposite. It's the nightmare scenario. Sticky inflation in the US, a spike in oil prices, it forces central banks to stay hawkish. The rising cost of debt just crushes the margins for these power projects. And that quiet accumulation we're seeing right now, it turns into a violent sell-off as all those institutions rush for the exits at the same time.
And finally, we have the black swan. Now this is a low probability but incredibly high impact event. Imagine a massive Mumbai-style grid failure, but this time it's caused by the insane power demand from all these new AI data centers. The government would have no choice but to respond with an immediate halt on all new projects, and the entire thesis driving this FII rotation would just evaporate overnight.
So, with these three totally different outcomes on the table, the crucial question is how you manage the risk. The answer isn't your gut feeling. It isn't a guess. It has to be a strictly mathematical protocol.
In this slide right here, this is the rule book. Non-negotiable. It's a three-step protocol. First, your stops have to be based on the average true range, the ATR, to respect the market's actual volatility. Second, you have to use trailing stops to lock in your profits as the trade moves in your favor. And third, you identify the major support levels on the broader Nifty Energy Index, and that becomes your ultimate line in the sand. You don't cross it.
For a strategy like this, the ATR is the single most important number on your screen. It is a direct measure of an asset's real-world volatility. For a stock like Adani Energy, the current daily ATR is around 39 rupees. Your stop loss shouldn't be some random percentage you pulled out of thin air. It should be based on this number. It's really the only way you can stay in the game and ride the kind of volatility this sector is going to see.
So it all comes down to this one question. A question that every major trading desk is grappling with right this second. Are you going to position yourself for the once-in-a-generation upside of this AI-driven infrastructure supercycle, or are the macro risks just too high to take the shot?
Hey, if you got value from this deep dive into institutional flows, do me a favor and hit that like button and subscribe for more analysis that actually goes beyond the headlines. And we want to hear from you. Drop a comment below with the Indian infrastructure ticker you want us to put through the backtester next. As always, manage your risk, and we will see you in the next breakdown.